headlines we're tracking this hour in bonds. ECB President Mario Draghi's bond buying program calls for unlimited purchases of government debt. But according to central bank officials, the purchases will be, quote, sterilized. Under this plan, the ECB would refrain from setting a public cap on yields and focus only on government bonds with short-term maturities of up to 3 years. Meanwhile, Pimco's Bill Gross is out with a new investment outlook. In the report, he says the private credit market is too high and the age of credit expansion is officially over. Instead, investors face an age of inflation, which typically provides headwinds for both stocks and bonds, which leads us to our top story in bonds today. Bill Gross tweets out some new investment advice. On the crisis in Europe, Gross writes, Draghi appears to be willing to write 2 to 3 year checks to peripheral countries. Very reflationary. Buy gold, tips, and real assets. Joining us now, such an honor to explain this tweet, is the bond king himself, Bill Gross, Managing Director and Co-Chief Investment Officer of Pimco. Welcome, Bill. Thank you for joining us today.
Thanks for having me, Stephanie.
Now, walk us through this tweet for a moment, because just an hour ago, we sat down with Jim O'Neill of Goldman Sachs, who said this is such a real move on the ECB parts for fundamental change and really start to correct things, whereas the LTRO was sort of the ultimate in can kicking. What's your take on this bond buying program?
Well, I think it could be. You know, the market awaits a 24-hour from now announcement, I suppose, in terms of what it might be. And even then, you know, conditioned upon some rulings from the Constitutional Court in Germany on the 12th. But in any case, it appears, you know, based upon unofficial leaks, that the program, yes, will be limited to 1 to 3 year bonds, but that ultimately, and this pertains to the reflationary aspect that I tweeted, that ultimately it will lead to an expansion of the ECB's balance sheet, currently at $4 trillion. We don't know how much it will expand, but nonetheless, you know, a $4 trillion balance sheet, when it, you know, several years ago was $2 trillion or less, you know, is a doubling in terms of a central bank's, you know, monetary base. And so we're about to see an expansion of ultimate hundreds of billions in terms of the ECB, which at some point has the potential for inflationary aspects.
According to your new investment outlook that you just put out, investors should be prepared for tempered returns, both in bonds and stocks. If that's the case, should investors be putting any money into funds at all, or should really they go for the lowest price option and just buy the S&P?
Well, you know, certainly from the bond standpoint, let's be clear in terms of my cult of equity. It's really a diminished or dying cult of both bonds and stocks from the standpoint of a belief that they can return 10%, you know, types of returns to pay their bills, to pay for education, to pay for retirement. You know, those days are over, if only evidenced by the fact that the bond market in the U.S., the investment grade bond market, only yields 1 3/4%. How can you produce a 10%, you know, type of return historically that we've seen for the past 20 or 30 years with 1 3/4% yields? It really can't be done. And similarly, you know, if equities are related to bonds and attached, or as I pointed out, conjoined at the hip in mathematical terms, then you would expect equities as well to produce less than 10% returns, you know, going forward. And so pension funds and individuals and investors that expect, you know, 10% consistent returns to pay those bills are going to be disappointed. And we expect 2 to 3% returns from bonds and 4 to 5% from stocks. And if you know, younger investors want to invest in stocks, you know, with that 4 to 5% expectation, then, you know, we suggest they do it.
Hey, Bill, so that being said, what are you out there buying as a result of lower returns in general and the ECB's announcement today?
Right. Well, I think with reflation as the odds-on probability, you know, it's clear that the world is in a deflationary, reflationary type of mode and doesn't really know which way to go. But if central banks are successful in terms of reflating, if Bernanke is successful in terms of a new QE, you know, then an investor should be focused on reflationary assets, and that would be, real assets such as commodities and gold, to the extent that they reflect future inflation. On the bond side, that would be inflation-protected securities such as TIPS or even floating rate securities that don't have a fixed coupon, and stocks as well. Stocks that in some cases can keep up with inflation and aren't buffered by a headwind in terms of those higher inflationary rates, which in historical terms has occurred. But stocks are not a bad bet either. It's just that all of them as a category cannot produce the returns that investors have grown used to.
Do you think the U.S. is falling back into a recession?
I don't think so. I think Bernanke has been successful up until this point. 2%'s the number, plus or minus, in terms of real growth, and it appears that we're about at that level now. We do have some, dramatic fiscal cliffs and some dramatic changes, perhaps, in terms of, fiscal attitudes going forward and fiscal budgets, and so, those in combination with the weakened effects of monetary expansion in the U.S., with the weakened effect of QE1, 2, twist, and perhaps now QE3, then yes, ultimately, it's going to be difficult to stimulate the real economy in the U.S. at a faster rate than 2%, and perhaps, even less if we have that fiscal cliff in December or January of 2013.
And Bill, I'd love to bring you back in. Could you explain to our viewers how gold actually helps investors protect their wealth in times of inflation?
Well, gold can't be reproduced. It can certainly be taken out of the ground at an increasing rate, but there's a limited amount of gold, and there has been an unlimited amount of paper money over the past 20 to 30 years, and now, in this period of central bank expansion, whether it's QE1 or QE2, or whether it's the LTROs with the ECB or this potential new program which might be announced tomorrow, then central banks are at their leisure in terms of basically printing money. And so gold as a fixed commodity has a considerable store of value that paper money has not. It's certainly dependent upon the price, and it's hard to know whether current levels for gold are the appropriate price. But when a central bank starts writing checks and printing money in the trillions of dollars, it's best to have something that's tangible and that can't be reproduced, such as gold.
Then, Bill, from a technical standpoint, is the gold trade too crowded?
Well, I don't think so. Central banks got out of the gold trade a few years ago, and now just recently are coming back into that market. Central banks have trillions of dollars of reserves. We're talking about China. We're talking about Brazil. We're talking about Mexico, countries that have earned, a surplus of reserves, and they have choices in terms of how to invest them. Would they want to invest them in a 1.55% 10-year treasury, or would they want to invest them in something, that's more tangible and that they can't be fooled with in terms of the marketplace? And so central banks are coming back into the market. You've seen some diminished demand from countries such as India, which have suffered in terms of their economic growth. So there's a yin and a yang there. But I think for the most part that it's not a crowded trade yet, even though the price is certainly accelerated in recent quarters and recent years.
So, Bill, how would you be then buying? Would you be perhaps dollar cost averaging? Would you be buying on dips more strategically? What's your game plan?
Well, for institutions, such as, Pimco runs, we have a commodity real return fund, which is an appropriate vehicle to, to participate with not only gold, but with copper and other commodities that can't be reproduced quickly. You mentioned orange juice just in the last few minutes. There's something, yes, you can plant a tree, but it takes a long time for it to grow. So you want a commodity that can, be tangible and unable to be reproduced, such as wheat or corn on the other side. So, an investor can participate through a fund such as Pimco's fund, or they can buy an ETF. In the gold market, of course, there's the famous GLD, which is an ETF which allows an investor to easily participate in the commodities market.
Hey, Bill, before we let you go, sort of big picture on the election, is there a different Bill Gross game plan for a President Obama victory versus a Mitt Romney victory in November?
I don't think so yet. We're talking about that in our investment committee in terms of how to play this. Obviously the polls are 50-50, so it's hard to make a bet one way or the other. I think coming out of both Republican and Democratic parties in terms of the ultimate outcome will be some type of tax reform that levels the playing field and perhaps promotes some productivity going forward. I think the important point in January or February of 2012 will be how both of these parties come together to address the deficit. If it stays at 8 to 9% going forward, then that leads to Fed QEs and to Fed purchases and to ultimately higher reflation going forward. So, we're going to be watching carefully the aftermath of the elections and how these parties come together in terms of fiscal policy going forward. It will be critical.
All right, Bill, so get out your crystal ball. What's your gold price target for the medium term?
I'm not a gold bug. I'm just suggesting that gold as a real asset, will be advantaged if Federal Reserve or ECB central banks start to write checks in the trillions. And so what my objective is, I'm not sure. I just think it would be higher than it is today, and certainly a better investment than a bond or a stock, which probably will return only 3 to 4% over the next 5 to 10 years.
All right, to point out that during QE1, gold prices were up 36%, and QE2 up over 20%. All right, thank you so much, Bill Gross. Here is what you need to know. Pimco's Bill Gross is bullish on gold and other real assets like corn, wheat, copper, orange juice as the investors face an age of inflation that could provide a headwind to stocks and bonds.